Hello everyone, and welcome. Today, we are going to take a journey into the history and the inner workings of technical analysis, and perhaps meet the primary architect behind those countless hours you spend in front of your screens. Our subject is J. Wells Wilder Jr. His name might not mean much to you at first, but if you've ever opened TradingView, checked the RSI to see if a price is overextended, or looked at the ADX to gauge trend strength, you are already well acquainted with this man. Today, we're talking about a genius who truly revolutionized the world of technical analysis, rewrote the rules of the game, and the incredible legacy he left behind. I want to take you back to the hazy atmosphere of the 1970s. Imagine those days for a moment. No smartphones in our pockets, no computers providing instantaneous data streams in our homes, and no colorful screens where you can add indicators with a single click. We are talking about an era where traders spread graph paper across tables, drew prices by hand on millimeter paper with pencils, and even calculators were considered a luxury. In the midst of this very chaos, a man searching for order stepped forward and said, "The emotional movements of the market can actually be aligned with mathematical discipline." He then sat down and invented the alphabet of technical analysis. Famous indicators like the RSI, ATR, ADX, and Parabolic SAR, tools we still use today across everything from cryptocurrencies to forex markets. These tools, which we use with a single click today, entered our lives through Wilder's 1978 book, New Concepts in Technical Trading Systems, which is considered the holy Bible of technical analysis. Nearly half a century has passed since then. Our technology has evolved at light speed, and AI algorithms have taken over the markets. Yet, the incredible thing is this: the formulas Wilder calculated by hand back then are still the most reliable safe harbors for millions of traders today. In this broadcast, we won't just skim through Wilder's biography. We will dive into the depths of his engineering mind, ask, why did he write this formula this way? And most importantly, discuss in detail how you should use these tools in today's modern and wild markets, especially with Bitcoin and altcoins. To get inside Wilder's mind, we first need to look at his background. Wilder wasn't originally from a finance background. He was a mechanical engineer. In the early years of his career, he worked in real estate development. Perhaps the cold-blooded, disciplined perspective he brought to technical analysis stems exactly from this engineering foundation. For an engineer, there is no such thing as maybe. There are only numbers, forces, and precision. When he became interested in financial markets in the mid-70s, he wasn't satisfied with what he saw. People were making random guesses based on instincts, looking only at price and volume. He, however, saw price movements like the motion of a physical object. It had momentum, it had friction, and it had velocity. He wanted to fit this soul of the price into a mathematical model. To him, indicators were not magic wands, they were decision support mechanisms. Real success lay in the trader's ability to follow these rules without emotion, with the discipline of a robot. Now let's open Wilder's toolbox and start with his most famous invention, the RSI, Relative Strength Index. Most people think the RSI is just an overbought, oversold indicator, but that's like using a Ferrari just to go to the grocery store. The RSI is a momentum oscillator. It tells us not just how much the price has risen, but how eagerly and fast it has risen. It tells us the power of the engine. Yes, there is that classic rule we all know. Above 70 is overbought, below 30 is oversold. However, there is a crucial detail Wilder explained in his book that most new generation traders overlook. In strong bull markets, for example, when Bitcoin starts a rally, selling just because the RSI went above 70 doesn't mean the trend is over. On the contrary, the RSI staying above 70 shows how strong the trend is. According to Wilder, in strong trends, these zones can shift. In a bull market, the RSI might fluctuate between 40 and 90, while in a bear market, it might get trapped between 20 and 60. The real goldmine here is what Wilder called failure swings, known today as divergences. Think of it this way. The price makes a new high, everyone is buying with excitement, but the RSI fails to surpass its previous peak. Do you know what this means? It means the price is rising, but the buyers are losing strength. The engine is stalling. This is a negative divergence and the clearest harbinger of a decline. Conversely, if the RSI is making higher lows while the price is making deeper lows, it means sellers are exhausted. A reversal is near. Wilder argued that one could trade based on these formations on the RSI alone, without even looking at the price chart. So, why do these indicators work so stably? Why don't they produce constant false signals like others? The secret lies in his unique averaging method called Wilder smoothing. Standard moving averages react to price too quickly, constantly stopping you out in whipsaw markets. But Wilder, through this special smoothing math he developed, absorbs sudden price shocks and market noise. This method adds a bit more memory to the price. It doesn't immediately erase the influence of the past. The ATR or ADX indicators you use today quietly utilize this mathematical filter in the background, which is why their signals are more reliable. Let's move to the first and most important tool when it comes to risk management, the ATR, average true range. Look, friends, this indicator doesn't tell you to buy or sell. It doesn't care about the direction of the price. The ATR measures the pulse of the market, its volatility. With the ATR, Wilder sought the answer to this question: how crazy is the market today? How aggressive are the players? If the ATR is rising, it means price bars are lengthening, the intraday spread is widening, and the fight is intensifying. So how do we use this? Most amateur traders use fixed stop losses. For example, they say, I put a 2% stop on every trade. But if the market is very volatile that day, a 2% distance remains within the market's natural oscillation and stops you out for no reason. Wilder says, adjust your stop level according to the market's volatility. If you set your stop level 2 ATR units away from your entry point, you are mathematically protected from the market's current noise. In other words, the ATR is your seatbelt, especially in wild markets like crypto. It protects you from the crash. Another vital tool is the compass of the trend, the ADX and DMI system. Most people confuse trend direction with trend strength. Wilder built a magnificent structure to solve this. Imagine you are in a car pressing the gas, but you don't know if the car is going east or west. This is where plus DI and minus DI come in. If plus DI is on top, buyers are at the wheel. If minus DI is on top, sellers are. But the real boss is the ADX. The ADX measures the strength of the trend. This is critical. Please pay attention. If the ADX is below 20 or 25, the market is asleep. The market is horizontal and indecisive. Wilder says, do not use trend-following systems when the ADX is low. You will lose money and get caught in the whipsaw. But the moment the ADX lifts its head and passes 25, that's the signal. The trend has started. Fasten your seatbelts. Whether it's up or down, if the ADX is rising, that trend is strong. So, if plus DI is on top and the ADX is also rising, that is a full-force bull market, and you don't stand in front of that trend. And our final weapon, perhaps Wilder's most sophisticated design, the Parabolic SAR. Those dots lined up like beads above or below the price on your charts. SAR stands for stop and reverse. Wilder designed this system to extract maximum profit from a trending position and to eliminate emotion. These dots follow the price as it rises, chasing it. But if you notice, as the trend extends, the distance between the dots widens and they begin to approach the price faster. This is called the acceleration factor. Because Wilder knew that risk increases as a trend lengthens, he brings the stop level closer to the price more aggressively. The moment the price turns and touches this dot, there are no questions asked, no analysis done. The game is over and the position is closed. The Parabolic SAR is a fantastic follower that takes the stress of "where should I sell?" off the trader's shoulders. When we put all these pieces together, a magnificent strategy template emerges, one that comes from 1978 but still works today. Imagine you've opened a Bitcoin chart. First, you look at the ADX. Is it above 25? Yes, so there is a strong trend. We aren't moving sideways. Then you look at the DI lines, plus DI is above minus DI, so the direction is up. Then you get confirmation from the RSI. It's above 50 and momentum is behind us. You make the entry. So where do you exit? That's where you hand the stress over to the Parabolic SAR. As long as those dots are below the price, you sit back and enjoy the trend. The moment a dot touches the price, you say thank you and leave the table. To wrap up, my friends, J. Wells Wilder Jr. didn't just leave us a set of mathematical formulas. He taught us to look at the market like an engineer and that there is order within the chaos. Prices change, technology changes, the players in the exchange change, but the only thing that never changes is human psychology, fear, and greed. Because Wilder's formulas are directly the mathematics of this psychology. They worked in 1978, they work today, and they will likely work 50 years from now. The RSI won't lie to you. The ADX doesn't take sides. They only process the data. What matters is whether you can use these tools with discipline. I hope this broadcast has changed your perspective on charts even just a little and helped you understand the value of Wilder's legacy. I wish you profitable, disciplined days where the trend is always with you. Goodbye.